Okay. Yes, we are live. Hello everyone. Welcome back to the second class, or the second session on derivatives. Hopefully all of you have managed to revise what we did in the last class and also practice the questions yourself. Just if you can give me a message on the chat saying everything is clear, you can hear me well, you can see me fine, you can see the screen clearly. If you can just do that, that will be helpful. Just a thumbs up or a message would be good, please. I am also just opening the chat. Okay. Can you all see me, hear me, see the screen clearly? Still waiting for a response. Okay, thank you everyone. So I think we've got to go ahead that it's all working fine on the tech side. So let us start. So as I was saying, hopefully you've managed to revise what we did the last time and also attempt the questions yourself once, along with the other questions in the scanner and in the practice material pertaining to the topics we discussed on Sunday. Definitely that should be helpful. And in case of any questions, any doubts, please feel free to reach out. I'll be more than happy to take them as we go along or even towards the end of the session today. So the plan today is to cover the balance topics. So last time we went through futures and forwards, did some questions including on arbitrage opportunities as well as the valuation part. And then we also looked at options. So we understood the basics of options, what put call options are, how do you compute the payoffs, the values, etc. So the plan today is to deep dive into the various valuation techniques. So binomial model, which is risk neutral, and then you also have the delta hedge, along with focusing on the put call parity. A few important concepts here from an examination standpoint. And then we will also be looking at things like interest rate swap. We'll also be looking at Forex, a couple of questions on these 2 points which are linked to the derivatives. So yeah, again, it will be a mix of certain concepts along with examination questions to strengthen those concepts or to test those concepts. Right? Like last time, please feel free to ask as many questions as you want. As and when you have any doubts, please feel free to put them on the chat, and I will take it up as we go along. Just getting a couple of questions. Interest rate risk management. Yes, so we will not be covering all the techniques, but yes, we'll be looking at a couple of questions where we touched upon the interest rate risk management part, like the swap, interest rate swaps, and as I said, also on the Forex side, forwards and futures and Forex, how is that interplaying with derivatives. So we look at a couple of exam questions on that. Hopefully, Yash, that was clear. In case of anything else, please do let me know. Okay, so if no further questions at this stage, let us start with the session. So a quick recap or a quick question before I jump into the topic today. Last time when we were talking about put and call options, we looked at the payouts. If you can see, we looked at how will the payouts be when the call is out or in the money, and same ways for put. So a very basic question to people online. Let's say you want to invest in an asset. Very simple, forget derivatives for a second. You want to invest in an asset, and the asset will give you 10 rupees in 1 month's time. You want to hold the asset for 1 month, and that asset will give you 10 rupees. Okay, very basic question. Think logically and give me the answer. What is the maximum price you want to pay for that asset? You want to hold the asset for 1 month, and that asset will give you 10 rupees at the end of the first month. What is the maximum price you want to pay for that asset? Very basic, simple question. I want a logical answer. Please tell me, what is the maximum price you want to pay for it? It will give you 10 rupees in a month's time. How much would you pay for it? Would you like to pay 12 rupees for it? Would you like to pay 50 rupees? Would you like to pay 5 rupees? Would you like to pay maximum 10 rupees? What should be the answer? Again, as I said, please give me a logical answer. Forget derivatives for a minute, just pure logic. We all are finance students, so I think we can answer logically. Yash says one more time the question. Yes, so you are investing in an asset and your time period is 1 month. After that 1 month period, that asset will give you 10 rupees. If you want to invest in that asset, what price would you be willing to pay for it? I get an answer of 10. So do we say 10 is the maximum you want to pay for it? Or someone is saying we can also pay more than 10? Anyone here saying we can pay more than 10? Or 10 is the maximum we would like to pay for it? Maximum 10? Yes, absolutely. That's correct. If an asset is giving you 10 rupees of return, from a logical standpoint, you would never pay more than 10. And one more thing which you would like to keep in mind, that asset is giving you 10 rupees at the end of the first month. So if you have to decide the price today, you should also discount that 10 rupees in present value terms. Yes, so yes, I'm getting some answers of 10, absolutely correct. So maximum of 10, but at the same point, we would also like to discount that for a 1 month period to get the present value. Hypothetically, the present value comes at 9.5. So we would say that today, if we have to pay for that asset, at max, what we'll pay is 9.5. Hopefully that is all clear. Yes? Okay. If that is all clear, then let's look at the payouts, what we discussed in the last class. Just taking, let's say, the call option as an example. So here, we had the intrinsic value in the column 4. This was the intrinsic value for the options, and just taking one example where the market price was 485 and we had the exercise price was 475, right? So we had an intrinsic value of 10. Now again, if I ask you this question, for this asset, if the intrinsic value is 10 and you know that the price will be around, let's say 485, you want to pay exercise price is 475, what is the maximum price you would pay for this call option? If you want to buy this call option today, what is the maximum price you want to pay for this call option? Again, simple, 485 and 475. That's the example I'm taking. Give me the answer here. What is the maximum price you would pay today for this call option, which is with an exercise price of 475 and you expect the intrinsic value to be 10? All of you. I got some answers last time. What about this question? Can we say again for this call option, because it will pay us maximum of 10 based on the current assumptions, we would only pay 10 rupees for this option? Yash says 15. Yash, why do we say 15? The maximum profit will be 485 minus 475, so that will be 10. So the intrinsic value is 10. Do we agree that again we would maximum for this call option pay only 10? 465. I'm just talking about the option, not for the shares. So okay, let me repeat. The call option gives us a right to buy. So the current price of the share is 430. The exercise or the strike price is 475. Okay? The premium on this is 4 rupees. So forget premium for a minute. The call option gives us the right to buy the share at 475 in 3 months' time. In 3 months' time, if the share price is 485, okay, the exercise price is 475, that means you can buy the share for 475. So you will have a value of 10 in your hand. What is the amount which you would be willing to pay today for this call option? If the maximum profit which you can derive is 10, would you be willing to pay more than 10? So this premium which we have here of 4, will you be willing to pay a premium of more than 10 for this call option? Is that making a little sense? Chalo, let me rephrase the question in a different way. When I was explaining the concept of options, I was equating it to insurance. You take an insurance policy for your car or for health, which is giving you a maximum payout of 1 lakh. It says, bhai, your coverage is up to 1 lakh. If you have to pay a premium for that policy, will you ever pay more than 1 lakh as a premium? Yes or no? If the coverage of the policy is 1 lakh, will you ever pay more than 1 lakh for that policy? Tell me. Yes, no? इसका तो आंसर सिंपल है. If the coverage is 1 lakh, will you ever pay more than 1 lakh? Can we safely say no? We will not pay more than 1 lakh? Some answers would be helpful, whether you are following it or not. So, maximum premium payable will be 10. Yes, Anup, very good. So, let me explain again. Health insurance. The policy amount is 1 lakh rupees. question is, hypothetically, when you are deciding the premium, can your premium be more than 1 lakh? The answer is no. If the maximum benefit from this insurance policy is 1 lakh, you will never pay more than 1 lakh. Correct? Do we all agree? At max, it can be 1 lakh, which of course will also not be true because it's a policy for 20 years, 15 years, whatever there is. So you will have a much smaller amount, but hypothetically, you will never pay more than 1 lakh. The same logic applies to valuation of options, which we will be talking about today. We'll be talking about 4 different methods, but the rationale is, how do you value the options? You value the options based on the expected benefit which you can derive from those options. And therefore, Anup, what you said, maximum premium payable will be 10, was absolutely correct. That in this case, if I expect the price to be 485 and the exercise price is 475, so that means I am expecting a intrinsic value of the option of just 10. So I would never be wanting to pay a premium of more than 10. And of course, as I said, we will discount that to present value terms and then come to the premium. So the intrinsic value on the options is basically the value of the option itself, which is the premium amount. So in this case, the premium was 4 is in my example. This is the fundamental. Now we will look at a few questions, we will look at a few examples which will help you understand what I'm saying. But the principle is, for an option, when the option writer or option seller is deciding the premium amount, they will always keep in mind the intrinsic value or the expected value. Based on that, they will derive the premium amount. Otherwise, the option seller may want to charge a higher premium, but there will not be any buyers for that option. Does that make sense? If not, please tell me. I'm more than happy to repeat that again. Fundamentally, does that make sense? Yep. जैसे हमने वाला क्वेश्चन किया था, assess the share price. So just taking a step back, when we did question number 6, which was Trimurti from June 25, we calculated the expected share price, which was 597, right? Then we said if the exercise price prevails, that means after 3 months the price of the stock is 597, then what is the value of the call option? So we said because the share price is now 590, expected exercise price is 590, so the value is 0. And the other way we said was the exercise price is 590, but the share price, expected share price is 597, so you had an expected value of 7. So these were the two ways we valued, but how are we valuing the option? We were saying what's the exercise price and what is the expected share price, and the difference between the two was the value of the options. Same logic is what I explained. थोड़ा सा अब इसको deep dive करते हैं. So now let's look at some of the specific valuation methodologies which is there in our curriculum, and as I said, it's a highly testable topic as well. You will see a lot of questions on valuation of the options, and some of the common methods which are being tested are put call parity and binomial method. Under binomial method you have of course the risk neutral or the basic method, and then you also have the delta hedging method. So we will look at all these 3 methods and some questions associated with these methods. Okay, so आगे चलते हैं. So put call parity is the first of the methods which we will be looking at. It's a very basic fundamental method with some premise which should be logical to understand. We talked about put option, which was right to sell, and we talked about call option, which was right to buy, right? These are the two options which we discussed, call and put. Now, let's start with a question to all of you. If there are two assets, ठीक है जी? Asset 1, asset 2. Let's say the cash inflows from asset 1 are 500, asset 2 are 500. Your time period is 1 year. ठीक है जी? There are no differences in the risk profile. That means all the other factors associated with asset 1 and asset 2 are the same. Okay. So now my question is, if someone has to value these two assets and say how much will you be willing to pay for these assets, can I say that the cost for asset 1 is, let's say, 50 and cost for asset 2 is 65? Do you think in a market where these two assets are there, this kind of a distinction in price will be justified? Will people actually go for asset 2 if there is no differentiation between asset 1 and asset 2? Both are giving us the same return, the risk characteristics are the same, everything else is the same. So from a commercial, practical perspective, do you think someone will pay a higher price for asset 2 when asset 1 is is available in the market for a 50 rupees price as compared to 65 rupees for asset 2? A question to all of you. Do you think, is that logical? Or people will say the asset 2 price should also be 50 or asset 1 price should be 65, but there should not be a distinction between the prices of the two assets. Do you think that makes sense? Yes? Yes, no, maybe? Any thoughts? So, yes, the answer is, of course, it should not be like that. There are two assets which are exactly the same characteristics, giving us the same cash flows, are having two different prices. Yes, it's possible, but at the same time, it will then converge. Otherwise, the other asset will not be sold in the market because people will always go for the asset with the lower price. So that is what exactly the put call parity theory is all about. Let's deep dive into the put call parity theory. So, as I said, we talked about put and call options, and we looked at what the characteristics of the features are. Now, what does put call parity theory say? Put call parity theory saying, if you buy a put option, when you buy a put option, what do you pay? You pay the premium, and if you buy the underlying stock, what will you pay on the stock? The actual price, so the prevailing share price. Yeah. The cash flows from these two will be equal to the cash flows if you buy a call, which again, buy a call means you pay the premium. Yes, and you buy a bond. That means you invest in a risk-free asset. In a risk-free asset. The cash flows from buying a put and a stock plus buying a call and investing in a risk-free asset will equate. This is what a put call parity implies. let's see with an example how does this actually work, and then we'll go into the detail of the rationale and how do we test it from an examination standpoint. But एक बार basic example देखते हैं. Hopefully this example will give you complete clarity on the put call parity rationale. ठीक है जी? So call option exercise price is 200, put option का exercise price is 200. So the exercise price of the put and the call option will have to be the same. ठीक है जी? The price of the stock on expiry is 150, 170 as I have mentioned on the screen. Then the intrinsic value निकालते हैं. Then we look at the call intrinsic value and then we'll see. So let's start with the first one, and hopefully you have the payoffs in your mind as we discussed in the last class. If the price on expiry for a stock is 150 and your exercise price for the put option is 200, is your put option in the money, out of the money? Put option is right to buy, right to sell. So your exercise price is 200, but the stock price is 150. So will you sell it in the market for 150, or will you exercise the put option and sell the shares for 200? What's the view there? Will we exercise the price, the put option, or will we buy the share or sell the share in the market at 150? Yes, we will exercise the share and sell it for 200. So we exercised the put option, sold the share for 200. The market was giving us just 150. So how much are we earning on that? We are getting a value of 50. Similarly, if your exercise price is 200 and the market price is 170, will you exercise the put option? Yes. Similarly, why would you sell it for 170 when you can sell it for 200 in the market? So you again have a gain or intrinsic value of 30. Similarly, when it is 180, it is still in the money. You will have a gain of 20. At 200, it is at the money because the exercise price and the stock price are the same. So you don't get any value. And after that, of course, it is 0, 0, 0, 0 or NA because the put option is out of money. You can sell the share in the market for a much higher price, and therefore you will not exercise the put option. Yeah, that's clear. Now cash flows on sale of share. क्या आएगा? Just to remind, what have you done? You've bought a put, so that means you've paid the premium and you bought the stock. So that means you've paid the cost price. So cash flows on sale of shares कितने आएंगे? We'll get 150 here, 170 here, 180 here, 200. Basically जो भी आपका share price है, you'll be getting that 400 and 500. So what are the total cash flows which you are getting on the put and the stock? Total of 50 plus 150, so you're getting 200 here, you're getting 200 here, you're getting 200 here, you're getting 200 here, 200 here, 200 here, 200 here, 200 here. So the total of this, do we agree? यहाँ तक all clear? चलो अब कॉल पे आते हैं. Exercise price of 200, price on expiry is 150. If you can buy a share in the market for 150, will you exercise the call option and buy it for 200? Answer is no. You will buy it from the market. So यहाँ पे there is no exercise price, no value. Similarly, no value. So the price below your exercise price for a call option, there is no value in the option. So it's all 0 or not applicable. At 200, it is at the money, so it's indifferent, but of course you can always exercise it. So the value is 0 because 200 minus 200 is 0. Above 200, the market price, let's say, is 220 in the next row, but you can exercise the call option and get the same share for 200. So you would do that, you will pay less and get the share. So you have a value of 20, next 40, 200, 300. So the difference between the stock price and your option price, the exercise price on call option. Now cash flows from the bond. What does that mean? Cash flows from the bond क्या होता है? sorry. यहाँ पे 220 आएगा, 240, 400 and 500. Yeah, my bad. Okay, now cash flows from the bond. So on the left side we had a put option and a stock price. On the right side we had a call option and investing in a risk. Is the sound back? Can you hear me now? Can you please confirm if you can hear me now? Saurav? Are you able to hear me? As per the system, I think the sound should be okay, but if you can just confirm once, that'll be helpful. Are you able to hear me? Saurabh? Okay, I think I've got to go ahead from the system. So let me know in case you still have a problem and I can look at the issue. But yeah, hopefully I should be loud and clear now. Okay, so we were on valuing the options and we were discussing the put call parity theory, and in that we were looking at the theoretical price. So I was saying for call the option gives us a right to buy, and the price can, or the value of the option can never be negative, because we will never exercise the option if it is giving us a negative value, right? So that's the basic fundamental. Now let's look at how will you value, or how will you derive the value of the option. And the same logic as we discussed, the intrinsic value. For a call option, the higher the price in the market, the better it is for us. So let's take a simple example. The exercise price is 100 and the share price increases to 400. What's the value? 300. If it increases to 500, our value increases to 400, because we can buy the same share at 100, whereas it is being sold in the market for 500. So we save 400. So that's the intrinsic value. However, one thing which is different here is that you pay the exercise price today, you pay the premium today, but the exercise price is only payable at the end of the option period. So if your option period is 3 months, then you will only pay the exercise price at the end of 3 months. So therefore, in this case, what you need to do is to compute the value. You will say stock price, the current share price, minus the exercise price, but you need to discount it. And the same discounting, which is the exponential part, will also be applicable here. So you will discount it by risk into time. If it's 5% and it's for 3 months, then you do it 5% and 1 to 3 by 12, and therefore you discount it with that. And this is whatever is this number will give you the value of the call option. If you can, let's say exercise price is 0, then whatever is the share price is your maximum value. And therefore, if you see what we mentioned here is that the minimum price cannot be below 0. That's fine, and therefore it's maximum 0 or the share price minus the exercise price. And if the exercise price is 0, then the maximum gain you can have on a call option is the share price itself. So in my example, 500 minus 100 was giving you 400. If that 100 becomes 0, then maximum you can get is 500. Yep, does that make sense? So similarly, for a put option, क्या करेंगे? Same logic. It can never be below 0, but put option is right to sell. So if you can sell something in the market for 100 and your exercise price is 150, then you would rather exercise your put option and sell that share for 150 rather than selling it in the market for 100. And vice versa, if you can sell something in the market for 100 but your exercise price is just 75, then you will let the option lapse and you will sell it in the market for 100. So the same logic here also. How will you apply? It will be the other way around. The equation, instead of share price minus the exercise price, you will have the exercise price because that's a selling price. So the exercise price divided by e raised to power RT minus the share price. This gives you the value of the stock, so of the option, of the put option. Now in this case, of course, if your share price, let's say, goes to 0 and your exercise price, you've bought a put option on a share that actually goes to 0, or let's say goes to 1 rupee, but you can sell that share under the put option, let's say at 200, then your gain will be 200 minus 1 rupee. So you have a much higher gain if the put option exercise price is higher. Same logic, it cannot be ever below 0. So therefore, the maximum which you can gain is the exercise price discounted today, but the minimum of course is 0. Is that clear between call and put option, and how do you value these? Is that making sense? There is also an arbitrage point here, and as I said, after this we'll be looking at a few questions to just test this understanding. So let's look at an arbitrage point very quickly and then we'll come to the questions. So as I said, the put, the protective put and the fiduciary call will be equal, but if they are not equal, then is there an arbitrage possibility? Answer is yes, as we've seen. So how will an arbitrage opportunity work here? Let's look at this question and then we'll also find the arbitrage or understand the arbitrage process. So as I said, again, a very important topic because it's been tested multiple times, both on the valuation part as well as the arbitrage gain part or arbitrage loss, depending on how the facts are. So we're looking at question number 5B from December 2017. It was for 8 marks. The current stock price is 190. The strike price is 210. Price is 6 months. European put option is 10 rupees. So that means if you want to buy a put option right now, you can buy the put option by paying rupees 10. Yep. The risk-free rate is 5%. Basic information all given to you. Calculate the theoretical minimum price. So what it's saying is the minimum price of the put option at the end of 6 months. That's the first thing. And then it's saying show the arbitrage process step by step and find out the gain if the price on the expiration is 200 and the price on the expiration is 220. Okay. So a simple question, but important to understand the concept, and then you can apply it very well in this question. So let's start with the first, which is the theoretical price. So यहाँ पे क्या है? We have a put option here, right? Put option के लिए we saw the theoretical price calculation. Yeah. Exercise price discounted to today's time minus the share price. So that is the minimum price of a put option. So let's compute that and see what's the answer. Exercise price is 210, the strike price, divided by, it's 5%, but for 6 months. So the rate becomes 2.5%. And you discount this by e raised to power 0.025. Yes. Minus the stock price, which is 190. This should give me the theoretical price for the put option. Yes, do we agree? E 0.025, the value, as I said, should be given to you in the exam, so not be a problem. And this comes out to be 1.02532. So let's solve this. 210 and by 1.02532 gives us a value of 204.81 minus 190. This gives us a value of 14.81. So as per our calculation, the theoretical minimum price for this put option should be 14.81 rupees. Okay, yahan tak any questions, anything which is not clear? Now, see what is happening. You feel that the price of this put option should be 14.81. But what is the price quoted in the market? It is 10 rupees. So you feel that the price of this asset should be 14 rupees. Someone should pay 14 rupees for this or charge 14 rupees for this, but it is available in the market for just 10 rupees. So do you think there is a arbitrage opportunity here because of the mismatch in the price? The answer is yes. Based on the numbers, you can see that this is undervalued. That means the value of the put option is more than what it is being quoted in the market. It should be at least 14.81, but it is being sold for just rupees 10. So the answer to the second question, the arbitrage process step by step. So first of all, is there an arbitrage opportunity? Answer is yes, there is an arbitrage opportunity which is available here. Now let's see how can you tap into that arbitrage opportunity. How can you actually take benefit of that arbitrage opportunity? This will take us back to the put call parity theory. Let's revise that. What was that? So price of the put plus price of the share should be equal to price of the call plus the risk-free asset, and of course this was discounted today because this will take us back to 6 months. So e raised to power RT. This was the equation. Now in the examination, you may not be given all of these 4 components always. So like in this question, you have the price of the put, you have the price of the share, you have the risk-free because you know the exercise price, but you don't know the call option. So for arbitrage computation, you will ignore the call option part. Okay? You will do the exact same thing. That is, you will buy the put. If you're buying the put, then you also have to buy the share. Buy the share, the risk-free asset you were investing it, but now you will borrow at risk-free rate. Whatever is the difference is the arbitrage gain because of the mismatch in the put option pricing. Now, as I said, fundamentally this is being derived from the put call parity theory. So you don't need to worry about a different concept here. If you understood the put call parity, you should be able to solve the arbitrage point as well. आगे चलते हैं, इसको solve करते हैं, देखते हैं how does this translate into numbers. So now you want to buy the put. How much will you pay for the put? You will pay 10 rupees because that was the price given to you. You want to buy the share. How much will you pay for the share? 190. Again, price is being given here. So how much you need? How much money you need today? You need 200 rupees today. Agreed? Therefore, this is the amount which you need to borrow to invest. You will borrow this at the risk-free rate, which is again given to you, 5%. So if you borrow this at 5%, that means after 6 months, you have to repay this. So how much will be repaid by you? You will be repaying 200, exactly similar to what we did for the futures and forwards when we were talking about arbitrage. We again had borrowed it at risk-free rate. We are doing the same thing here. So 200, again, you multiply this by e raised to power 0.025. This comes out to be 200 into 1.02532. This comes out to be 205.064. So this much you have to pay after 6 months. Yes, do we agree? And how much will we get after 6 months? ये आपने calculate करा हुआ है यहाँ पे. Strike price is 210. Yes. So how much will we get? There are two cases. 200 if the price at the end of 6 months is 200, and if the price at the end of 6 months is 220. Let's look at the calculation for both these options. Agar you've able to understand the concept so far, then you can come up with the answer in both the scenarios. But if not, no worries, we'll look at with an example. With a detailed calculation. So the theoretical minimum price we had computed, this was coming out to be 14.81. Then we said arbitrage process, you buy the put by paying 10, you buy the share by paying 190, and therefore you borrow 200. After 6 months, you'll be paying this 200 along with interest. So the cash outflow after 6 months is 205.064. So all the workings which we did here. Yes. So अब देखते हैं after 6 months how is the actual arbitrage gain being derived by us. See, so what is the net position after 6 months? Stock price 200 and 220. This is given in the question itself. So if you see, the price on expiry is 200 and 220. Hopefully now you can see the screen better. So put option, all of you, the exercise price of the put option is 210. If the share price is 210, will you exercise the put option or no? The answer is yes. If the market is giving you 200 but the put option will give you 210, then you will exercise the put option. So the answer is you will exercise. And if you exercise, what is the payout? You get in 210 whereas the stock price is 10. So the intrinsic value of the payout is 10. When you sell the shares, how much are you getting on selling the shares? The stock price, which is 200. So, and you have to repay 205.064. So how much gain are you deriving in such a scenario? You're getting 210 minus 205.064. So this comes out to be 4.936. Is that clear? Does that make sense? Similarly, 220. The exercise price on the put option is 210. Will you exercise the option here, or you rather let it lapse and you sell the share in the market for 220? You let it lapse. So in this case, you will not exercise it. And you let it lapse. So payout will be NA because you're not getting anything on the put option. Sale of shares in the market. You will sell it in the market. How much will you get? 220. How much is the arbitrage here? 14.936. You're getting 220. You need to pay 205.064. Does that make sense? Now if you see, if you have to reconcile this, the strike price was 210 and the stock price was 90. So if you see the difference between the premium here of 10 and 14.81 is about 4.8. Because in the second example, they've increased the stock price. Therefore, you have a 14 rupees gain. Otherwise, your gain would have been 4 rupees as per the stock price of 200. So that's just a way of reconciling your answer with the first calculation you did on the valuation. Yep. One point to note is that a lot of these questions which we've done in the two sessions the answers may not match from the suggested answers or from the scanners. Because there are some errors in few of these answers, I should say more than a few answers. So you would see some differences if you want to compare what we've done in the sessions vis-a-vis what you have in the suggested answers or the scanners. So yeah, that difference will be there in a few questions, but unfortunately that's how it is. There are some mistakes in those answers there. So let's move on to the second option of valuation. What we did today till now has been put call parity along with the arbitrage point. Now let's look at the binomial model and how does this work. So this is basically building up from the put call parity, and we will see some questions where we'll apply both put call parity and binomial to solve for the requirements. And therefore, as I said, both of these models are concurrent to each other or complement each other when it comes to valuation of options. Binomial model का मतलब क्या होता है? In very simple terms, binomial model is you are predicting or anticipating the price of the asset to move in a direction. Let me just put this on charge. Okay. Yep. So, binomial model का मतलब क्या होता है? As I said, you are predicting or anticipating or interpolating the price of the shares. So basically, let's say the T0, the price is 100. You feel there are chances of it going up to 120, chances of it going down to 70. अगर 120 जाता है तो फिर से there's a chance of it going up to 150 and there's a chance of it going down to 105. Similarly, 70 के ऊपर भी जा सकता है 85, 70 के नीचे भी जा सकता है 60. So on and so forth. You can create as many nodes as you want for this example. And for each of these prices, there is a probability. So let's say इसकी probability 44% है, इसकी 56% है, इसकी 45% है, इसकी 55% है, इसकी 25% है, इसकी 75% है, and so on and so forth. As I said, you can keep creating these nodes and the binomial will continue. So this is the fundamental. And the point it says is that the probabilities will be such that it's a risk neutral calculation. That means there are no arbitrage opportunities which will exist the way you will apply these probabilities. So that's the fundamental assumption behind the binomial model. ठीक है जी? Easy, अभी तक basic, hopefully. No questions. In case of course any questions, please let me know. More than happy to answer that. ठीक है जी? आगे चलते हैं. So binomial tree, as I said, you can continue to create as many nodes as you want and it will be like a binomial tree. But from an examination standpoint, from a calculation standpoint, I am based on at least the past 10, 12 years of questions. It's generally been just the first level. They don't go beyond the first level from an examination standpoint. But yes, of course, if they want, they can always go beyond that. In some of the other courses, like for example CA or CFA, etc., you would see more than one level, but at least in CMA as of now, they've not gone beyond that one level. Let's take a very basic example and understand how do you compute the share price, or sorry, the option value, basing it on binomial. So let's take a very simple, as I said, example. The current price of the share is 100. The exercise price is 95. The risk-free rate is 10%. Standard deviation, in simple terms, this means the variance in the price. So it means 50%. So that means 50% it can go up, 50% the price can go down. That's what it says. And 3 months. And it's a call option. We'll start with the call option. Right? So let's say price on expiry. क्या हो सकता है? Is that 50% chances of the price going up? So 150? Well, 50% price can go up, 50% price can go up. Not the probability, but the actual difference in the price, the variance in the price. So it can be 100 का 150 हो सकता है if it is going up, and 100 का 50 हो सकता है if it is going down. ठीक है? Now, again, the same point around the payouts will apply here as well. If the exercise price is 95, will you exercise the option when the price is 150? It's a call option, remember. Yes, you will exercise. So, if you exercise, then 150 ka, it will be in the money and the value will be 150 it will be 150 minus 95. Yes. When it is 50, will you exercise the call option? No, you will let it lapse and you can buy the share from the market. So the price on expiry, if it is 50, then the option is out of the money and the value is 0. Yep. यहाँ तक कोई भी doubt? Exactly the same as what we've done so far. ठीक है? Now let's look at a different way of computing the risk neutral probabilities. As I said, in the binomial theory, we talk about risk neutral probabilities. That means no arbitrage. So how do you compute the risk neutral probabilities in this kind of a fact pattern? Let's look at that. So you start by first computing the expected price. Now if the current price is 100, it's a 3-month time period and the risk-free rate is 10%. So if you have to compute the expected price of the share after 3 months, how will you do that? Again, basic, we've done this for so many other topics, not only in derivatives but also in other chapters. What do? You say 100 is the price today, multiply by 1 plus r raised to power n. Now in this case we are continuously compounding it, so we'll apply the same logic here and we will do e raised to power r into t. So if you solve this, this will be 100 into e raised to power 10% and for 3 months, so 10% into 1 by 4, this is 100 into e raised to power 0.025. Yes? Do we agree? And if we solve for this, then gives us this gives us an answer of 102.532. So the expected price after 3 months for a stock which is currently valued at 100 gives us a price of 102.532. Now we will compute the probabilities. We will say there are 2 instances. Price can go up to 150, price can go down to 50. If the expected price after 3 months is 102.53, then what is the probability of the price going to 150 and what is the probability of the price going down to 50? Same simple maths, school linear equation. We'll say the probability of the price going up to 150 is, let's say, y. So this probability is y. So what is the probability of the price going down? 1 minus y. Right? What do? We say 150 is the price of probability going up. So 150 into y plus 50 into 1 minus y should give us what? 102.532. Yes? Price going up multiplied by the probability plus price going down multiplied by the probability should give us the expected price. एक दो questions हमने देखा था opposite where they were giving us the probabilities and they were asking us to compute the expected price. So in this case we've computed the expected price and now we are computing the probabilities. So if we solve for this, 150y plus 50 minus 50y is equal to 102.532. इसी को आगे सॉल्व करेंगे तो y की वैल्यू आएगी 52.53%. So if the probability of the price going to 150 is 52.53%, then the probability of price going down to 50 is 47.47%. Yes? Simple maths. Hopefully no confusions, no doubts there. आगे चलते हैं. So now we have the probabilities. We know what is the intrinsic value of 55 and 0. So what is the price, risk adjusted price of this call option? 52.53% multiplied by 55, which is the intrinsic value. The probability of the intrinsic value being 55 is 52.53%. So if we multiply these two, we get a premium of 28.89, or the value of 28.89 at the end of 3 months. In the second case, price is down, so the value is 0, so that gives us a 0 number, no change. Now we have to value this option today. How much will you pay for this option today? How much will you pay for this option today? 28.89 discounted by the same exponential e raised to power RT. We know the figure 102.532. So if you divide 28.89 divided by 102.532, 102.532, that gives us a number of 28.18. So how much will you be willing to pay for this call option today? It is 28.18. This is how you value a call option using the binomial method. Now I know there were a lot of steps involved, and we will also look at an examination question for binomial model, but this is the way you do it. Now as I said, we'll also look at an interlinkage between binomial model and put call parity. So if the value of the call option is 28.18, then can we apply put call parity and solve for the value of the put option? Let's see. Put call parity क्या होती है? Protective put, price of the put plus price of the stock is equal to price of the call plus risk free asset discounted. Yes? Let's solve for it. Price of the put हमें निकालना है. Stock price कितना है? ऊपर दिया हुआ था. Current stock price is 100. So 100. Price of the call कितनी है? अभी हमने निकाल लिया 28.18 और 28.18. yes. Plus risk free asset कितना देना चाहिए? Exercise price कितना है? 95. So 95 divided by 102 point कितना था? 532. इसको सॉल्व कर देते हैं. 95 divided by 102.532 gives us 92.65 plus 28.18 is equal to 120.83 minus 100. So the price of the put option should be 20.83. So this is how we've computed the price of the call option by the binomial model, and then we applied the put call parity to compute the price of the put option. We can also do it the other way around. The answer will be the same. Any questions, anything which is not clear? Otherwise I will move on to the next part. So binomial mein hi we have delta hedging. So as I said, what we've done so far is the risk neutral method. This is the principle which is applied, and now what we are doing is seeing another way of solving for it, which is called delta hedging or the delta method. Again, important examination point of view, a lot of questions you will see on this specific point, both binomial put call parity and along with delta hedging. So delta hedging is part of binomial, so it's the same, will give you the same answer, but has a different methodology to it. And then we'll look at one question where all these three methods have been tested and we'll solve for it. So very quickly, delta hedging क्या होता है? Or what do you mean by delta? So delta measures how much price of an option will change when the price of the underlying asset changes. So share price changes, what will be the impact on the price of the option? That is measured by delta. So simple, if the call option has a delta of 0.4, what does that mean? If the stock goes up by 1, the call option goes up by 0.4. Right? Positive tha, you bought it, same call option goes up, the price goes up by 1, the call option value also goes up by 0.4. That is what exactly is meant by delta. For call options, the delta is always positive, and for put options, the delta is always negative. Yes? Now, what do you mean by delta hedging? This was the definition of delta. Delta hedging is basically you adjust your portfolio based on what the delta is to see, okay, if you're holding the shares, then how many call options you want to sell, or vice versa. That is what you see by way of delta hedging. And abhi bahut clear ho jayega when we look at an example. Right? So let's say you sold one call option. So and call delta is 0.4. That means you are short the call because you sold it. I think last time we discussed, some people had asked this question that what is a short seller? What does mean by shorting and long positions? So short means you sold it. So when you sold the short call option, your delta is negative 40 because you sold it. So to neutralize it, to balance it out, what you do is you buy 0.4 units of a stock. Because you sold the option, you buy the stock. If you are buying the option, then you sell the stock. इसको देख लेते हैं. If the stock goes up, the call liability increases. You are selling a call option. Always remember whether you're selling or buying. Selling the call option. So that means if the price is going up, your liability as the seller is going up. If you bought the call option, if the price is going up, that means your value of the call option is going up. But if you also hold the stock, then though the price is going up, but you are also gaining on the stock price. So that's the rationale behind delta hedging. If I have to summarize very quickly, when your delta is positive and you are long call, that means you have bought the call option. Then you short the stock, that means you sell the share. When you're short the call, then you buy the stock. As explained, vice versa. Similarly, when you're long put, that means you bought the put, you buy the stock because your delta is negative. It's a put option. And when you're short the put, of course, that means the delta is negative because you're putting, then you short the stock as well. Clear? अब इसको देख लेते हैं formula perspective से. So if the concept is clear, then let's look at how do you compute the delta. How do you compute the delta? How do you see how much variance to be made to the shares? So as I said, for delta will be positive for the call option, negative for the put option always. CU is what? The price of the call option when the value goes up. So CU, price when value goes up of the call. CD, price of call when value goes down, and same for put up and put down, right? So how do you compute the delta, the hedge ratio? You will say for call, CU minus CD divided by stock price up minus stock price down. For put option up minus put down divided by stock up minus stock down. This will give you the value of the hedge or the hedge ratio which you have to maintain. And again, a lot of these things will become clear as we move on to the question on the next slide. जब hedge आ गया, तो how do you compute the value of the option then? Same logic, you say H into stock price minus stock price when it is down divided by e raised to power RT. This gives you the value of the call option. And you will see this value of the call option will give you the same answer if you compute the value of the call option by applying the binomial model. So it is the same, as I said, therefore delta hedging is part of the binomial model, but it follows a different approach or a different technique to valuing the option. Let's look at a question, again an examination question, 6B from December 23 for 7 marks. Let's read the question together and then we will solve it. The shares of Goxin Limited are presently trading at a price of 540, so the current price S0. After 3 months, the price will either be 600 or 480, okay, with respective probabilities of 60 and 40. So these are the probabilities which have been given by the question. These are not the risk neutral probabilities which we need for the binomial model. There is a call option that can be exercised at the end of 3 months at an exercise price of 510. Risk-free rate is 6% per annum, continuous compounding. Assume no dividends in the interim period. So they've simplified the question for us. Determine the value of the 3 months call option using the binomial model, but it says delta method. That means we have to apply this method, the formula based, not the binomial tree based, which was this method. But as I said, we will follow both the methods and solve for it so that you get the confidence that in the exam you can follow either depending on what the question says and get the same answer. Then it says value, analyze, assess the value of the put under put call parity. So as I was saying, generally it will ask you to apply the binomial model for one of the option types and then apply the put call parity to compute the value of the other option. And then it says lastly, analyze the expected value of the option and the stock price at the end of 3 months. So whatever is the expected value of the stock price and the option at the end of 3 months. So third part will again need to be computed based on the delta method, but we will follow the binomial risk neutral method as well to give you the answer. ठीक है जी, आगे चलें, चलो सॉल्व करते हैं फिर इसको. First वाला part तो बहुत easy है because it is directly the answer or directly the formula which we have to apply. So let's look at. So बताओ भाई, price is 480, sorry, price is 540. It can go up to 600. It can go up to 480. Exercise price क्या है आपका? Exercise price is 510. So question to all of you, if the exercise price is 510 and the price goes up to 600, what is the intrinsic value of your option? Will you exercise it or no? बताओ भाई, अगर 510 है और exercise price and the price in the market goes up to 540, you will exercise it? Answer is yes, you will exercise it. So exercise करेंगे, yeah, yes. What will be the value? 600 minus 510. The value will be 90. If the value goes down to 480, will you exercise it? No. What will be the value? 0. अब delta hedge में हमने क्या किया था? What was the formula of the hedge? First, we computed the hedge ratio, which was CU minus CD. So call option value going up, call option minus going down, minus divided by SU minus SD. Solve कर दो. CU क्या है? 90. Yes. Minus 0 divided by 600 minus 480. This comes out to be 90 divided by 120, which is 0.75. यह आ गया आपका हेज की वैल्यू, एच की और डेल्टा की वैल्यू. डेल्टा की वैल्यू आ गई तो उसके बाद अब क्या करना है? सीधा यू कैन अप्लाई द फॉर्मूला. कॉल ऑप्शन वैल्यू क्या थी? एच मल्टीप्लाई बाय द करंट स्टॉक प्राइस माइनस प्राइस इफ इट गोज डाउन divided by e raised to power RT. ये सारी फिगर्स आपको दी हुई हैं. All you have to do is directly apply into the formula and get the answer. Because it says delta method, so you can directly apply the formula. But as I said, we will solve this question by also doing the binomial method. But पहले delta method करते हैं, which is the requirement of the question itself. अब इसको solve कर दो. Price क्या है? If it goes up, if the current price is 540 minus what will be the price if it goes up or down? क्या लेंगे यहाँ पे? Down. What is the price if it goes down? 480, right? Divided by E raised to power कितना होगा? RT क्या है? 6% and this is for 3 months. So 1.5%. So E raised to power 0.015. इसकी फिगर आपको यहाँ पे दी हुई है 1.013. तो इसको सॉल्व कर लेते हैं. 480 divided by 1.05 1.015 gives us a figure of 472.853. So this is 540 minus 472.853, and all of this is to be multiplied by 0.75. So ये कितना आता है? इसको आप सॉल्व कर लो into 75.75. This comes out to be 50.36. So the answer of the first part, determine the value of the 3 months call option using the binomial model, the delta method, is 50.36. Straightforward, as I said, apply the formula and you can get the answer. आगे चलते हैं second part में. Assess the value of the put option under put call parity. अब यहाँ पे बहुत easy again formula, बिल्कुल formula लगाना है आपको. Protective put, which is P0 plus S0 is equal to call option plus risk-free rate, risk-free asset discounted for today. P0 निकालना है. कॉल की वैल्यू आपने ऊपर निकाल दी 50.36. एक्सरसाइज प्राइस गिवन है 510 डिवाइडेड बाय 1.015 माइनस स्टॉक प्राइस कितना है अभी 540. इसको सॉल्व कर देंगे तो हमारे पुट की वैल्यू आ जाएगी 510 divided by 1.0151113 is 502.4 plus 50.36 minus 540. This gives me an answer of 12.767. अगर आप लोग साथ में सॉल्व कर रहे हो तो आपका भी आंसर आना चाहिए 12.767. और अगर आप वीडियो देख कर सॉल्व कर रहे हो बाद में तो यस, मेक श्योर यू आर फॉलोइंग द स्टेप्स एंड नथिंग इज क्लियर, समथिंग इज नॉट क्लियर, प्लीज डू रीच आउट. So this gives us the answers for the second part, which is put option under put call parity. So if you see first two parts were directly linked to the formula. If you know the concept, you'll be able to understand the formula. If you're able to understand the formula, you'll be able to solve it without any doubt, without any confusion. It is a direct question giving you the inputs. Please apply them in the formula and you get the answer. Third, analyze the expected values of the option and the stock price at the end of 3 months. So यहाँ पे आपको सीधा probabilities दे दी हैं क्योंकि डेल्टा मेथड है तो आपको रिस्क न्यूट्रल probabilities नहीं लगानी अभी. So third part, expected value of the stock बताओ कितना होगा. 60% था into 600 plus 40% into 480 कितना आएगा 360 plus 96 192 552, right? This is the expected value of the stock. Again, absolutely straightforward. Expected value of call सेम तरीके से निकाल लेंगे. कॉल की वैल्यू आपने ऊपर निकाली थी 90. अगर ऊपर जाता है वैल्यू 600 जाती है तो देन व्हाट इज द वैल्यू ऑफ द कॉल 90. इसकी प्रोबेबिलिटी कितनी है 90 की. प्रोबेबिलिटी अप प्लस CD into probability down. 90 into 60% plus 40, CD 0 tha, into 40%. This gives us the answer 54. Absolutely straightforward, very simple question. All you have to do is ensure that you understand the concept of put call parity, you understand the concept of delta hedging, and you can apply it on a direct basis. No complications whatsoever. Yes? Now let's quickly solve this question by applying the binomial model and see whether we get the same answer of 50.36 or not. Right? So let's solve it. Hopefully, what we are doing today should give you the confidence that you should be able to get full marks in such kind of questions in the exam. As I said, it is absolutely straightforward. There are no complications. All you have to do is understand the concept and you can solve it. So let's now look at the binomial model. So हमने क्या बोला था? For binomial model, we can just create the table with the chart which we did in the last example which I was giving you for binomial model. So the price was 480, I think 540. Price is 540. It can go up to 600. It can go down to 480. यहाँ पे we said yes, you can exercise the option. यहाँ पे you will not exercise the option, it will lapse. The value was 90, 510 was the exercise price, and 600 is the share price. Here the value was 0. Yes? So the first step, compute the expected price at end of 3 months. 3 months here period है 6 months है 3 months है 3 months. So that should be 540 into e raised to power RT. This is 540 into 1.015 1.015113. 540 into 1.015113 gives us the answer 548.16. Yes? Second step is compute the risk adjusted or risk neutral probabilities. That's what we discussed. Yes, do we agree? Risk neutral probabilities निकालो. कैसे निकालेंगे? The probability of value of 90 is y and probability of down is 1 minus y. So क्या करेंगे अब? कैसे किया था? Do we remember? Yes? Anyone wanting to give it a shot? Or you think it's still confusing? Hopefully not. अब confusing बिल्कुल नहीं होना चाहिए. All of these things what we are doing should be absolutely clear in your mind. And if it is still confusing, please do let me know. As I said, I'm more than happy to explain all of these points again to you. चलो जी, तो क्या करेंगे यहाँ पे? 90 into y plus price. What is the price? 600 into y plus 480 into 1 minus y. This should be what? 548.16. 600y plus 480 minus 480y is 548.16. 120y is equal to 68.16. Y is equal to 68.16 divided by 120. That gives me an answer of 56.8%. So therefore, the probability of this is 56.8%. Probability of this is 43.2%. This gives me 100, yeah. So this is the probability. 56.8 into 90 is the expected value at the end of 3 months. I want the value today. So what will we do? So the price of call today is 51.12 divided by e raised to power RT. Now this I know the number, so 51.12 divided by 1.015113, this gives me the answer 50.36. Now see, what was the answer? 50.36 as per the delta method. And what we've done here, we've solved the same question applying the binomial risk neutral method, and we've got the same answer. So that is what I was trying to say, that the methodology, you can adopt either of those two, but you'll get the same answer. What you have to be mindful of is what the question is asking you to do. In this case, the question was asking you to do the delta method. Therefore, we did the delta method, which is the formula based. However, I also showed you the same question, solving it for with the binomial risk neutral method, not the binomial delta method, and getting the exact same answer. Yeah, hopefully that was clear. It's 1:50. Let's take a break of 5 minutes, a quick break, and then let's continue with the call options. We look at one more question, and then we will look at the swap, the interest rate swap, as well as the forex questions which I was talking about. So a few more concepts and a few more questions for today, and then we will close out. Yep. We'll see you at 1:55, and then we'll continue. Thank you. Okay, I think you should be able to hear me loud and clear. Let us continue. So let's look at now a question on delta hedging, where it's asking us to say compute not only the hedge ratio, but also to say how we can get an arbitrage gain from, or how we can hedge our position by the delta method. So let's look at a question there. Another examination question, 6B from June 23, Zetson, and this is for 7 marks. Okay, so Mr. Zetson is interested in purchasing equity shares of Rotex Limited, which are currently selling at INR 600 each. So the current price is 600 each. Expects the price of share may go up to 780 or may go down to 480 in 3 months' time. So 3 months is T. Changes of occurring such variations are 60%, 40%. A call option on the shares can be exercised at the end of 3 months with a strike price of 630. So strike price, ignore the transaction cost, assume no dividends in the interim period. So again, a straightforward, simple question. You can directly apply the formula. If you of course understand the concept, then you can apply the formula and you can compute the answer. Let's look at how to do it. So required, determine the combination of the share and option should Mr. Zetson select if he wants a perfect hedge. So if you see, what we're talking about here is a delta hedge, right? Because saying combination of the share and the option should Mr. Zetson select if he wants a perfect hedge, right? So tell me, we again can create a small table, which we did in the previous question, just to help you understand. In the exam, you can do it without the table also if you are comfortable. So the current price is 600. Say it can go to 780. It can go to 480. Your exercise price is 630. If it goes up to 780, will you exercise? Answer is yes. If it goes down to 480, will you exercise? Answer is no. So what is your CU figure? 780 minus 630, which is 150. And what is the CD figure? You're not exercising. So the answer is 0. Now, what was the formula for the hedge? So the delta? CU minus CD divided by SU minus SD. Now solve for it. And what is the answer you're getting? 150 minus 0 divided by 780 minus 480. So this is 150 divided by 300. This is 0.5. So the hedge or delta is 0.5. So the delta is 0.5. Then what should be the hedge? As we discussed, every share, every option multiplied by the hedge will give you the number of share. So in this case, if you have one call option, then the corresponding share has to be 0.5 because your hedge is 0.5. Right? So therefore, 0.5 shares should be purchased for every one call option sold for a perfect hedge. Right? So as we discussed. So in this case, since it's 0.5, let's take the example of, let's take 2 options. We're talking about call options here. And 1 stock. So that is again 1 by 2 is 0.5. Yeah, but it is just giving us a complete answer rather than decimals. So now, what will you buy? What will you sell? Read the question. Mr. Zetson is interested in purchasing the equity share. So that means they will buy the stock. If you are buying the stock, then you have to sell the call. So if Mr. Zetson in this case wants a perfect hedge, then they should buy 1 stock of Rotex Limited and sell 2 call options on Rotex Limited. Yes? And option should Mr. Zetson select if he wants a perfect hedge. So if he wants a perfect hedge, as I said, needs to buy 1 stock and sell 2 call options on that stock. Is that clear? Yep. Then, what is the second question? Explain how Mr. Zetson will be able to maintain identical payoffs regardless of the share price. So here it says once you set up the hedge like this, then what will be the share price what will be the payoff if the share price increases or decreases. So let's take two examples. Once when the share price is 780 and second when the share price is 480. The two examples which have been given in the question, the two share prices which have been given in the question. Now remember, you own the shares, but you've sold the call option. You're not buying the call option. So it will be, the payoffs will be opposite. When you sell the share, how much do you get? 780, 480. In the first case, will you have a loss on the call option? Because the option buyer will exercise the call option. So loss on the call option, कितना होगा? 780 minus exercise price was 630. Exercise price was 630. So 780 minus 630 into 2. This is 300. So this is your loss. What is the net position here? 480. When the price is 480, the option buyer will not exercise the option. You as the option seller need not pay anything more. So this will be 0. What is the payoff here? 480. Is this answering the question? Explain how Mr. Zetson will be able to maintain identical position regardless of the share price. So that is what we've shown, that if you buy one share and you sell two call options on that share, then your payoffs will be the same regardless of the share price. Yes? Let's move on to the third part. Calculate the value of the call option at the beginning of the period if the risk-free rate of return is 10% per annum. So what is it saying? Calculate the price at the beginning of the period. क्या लगाएंगे इसमें? Hedge, delta hedge method, and the value of the call option which we discussed here, right? We did this in the previous question as well. So it is asking us to do the same thing here. It will be H multiplied by the current stock price minus price when it goes down, discounted with e raised to power RT. Solve for it. Hedge हमने निकाला था 0.5 into current stock price कितना है? Current stock price was 600. 600 minus price if it goes down is 480 divided by कितना है? 10%, and what is the RT? Rate is 10% and the period is 3 months. Zero point 0.5 into 600 minus 480 divided by 1.025315 468.1488. Solve for this gives us an answer of minus 600 into 0.5, 65.926. So that is the third question, third part of this question. The fourth part is calculate the expected return on call option. Again, something which we did in the previous question as well. We have computed the payoffs here, 150 and 0. What is the probability? This is 60%, this is 40%. So multiplying this, payoff is 90. The expected return on the call option is 90. Very simple here. And then if it is 90, then what is the, yeah. So if this is the 90 is the expected return, then what is the present value? Again, we divide this with the exponential factor which we have. That gives us a number of 87.778. So if The present value is 87.778 and first part. Yeah, 87.778 is your expected value of the call option. Now it says, what is the expected return on the call option? Any thoughts on how will you compute the expected return on the call option? Anyone willing to give a shot? How do you compute the expected return in this case? Yep. Nahi? What all have you computed in this question? Just have a look. Taking a step back, we started with the perfect hedge, the combination. Yes? Then we computed the value. So the value of the call option is 65.93 and the expected value based on the probabilities is 87.78. Then what is the return? The return is difference between 87.78 minus 65.93. That is what you earned, which is 21.85. How much you earned? 21.85 on what number? You earned this on 65.93, which is the value of the call option as per the delta method. So therefore, the return is 21.85 divided by 65.93, which comes out to be 33.15%. Does that make sense? Is that clear? Yep. Again, no complications. If you understand the concept of delta hedging, if you understand the concept of how you compute the value of the call option, you will be able to solve this directly. Okay, chale. Should we move on to the next question? So left with two questions. One where we'll be talking about the forex along with derivatives, and the second question where we'll be looking at an interest rate swap to see how does that work in case of a practical question, and also of course understand the concept. First, let's look at forex along with derivatives, and then we look at the interest rate swap concept and the interest rate swap question. Chalo ji. Let's read this question. Recent question, 7A from June 25. Globe Tech came in for 7 marks in the examination. Let's read it once. Globe Tech Limited, an Indian electronics importer, has placed an order to import high-end semiconductor worth USD 500,000 or USD 5 lakhs, payable in 3 months' time. Okay. The company is evaluating different strategies to hedge its foreign exchange exposure. Fine. They're giving us some rates: spot rate, that is rate today; 3-month forward rate, which is rate in 3 months' time. When is the transaction expected to happen? 3 months. That means Globe Tech has to make a payment after 3 months. Very clear. Then it says USD call option 3 month strike price, premium on this as well. So it's giving us information on forwards, it's giving us information on call option. So 2 hedging instruments have been provided to us. Let's see. Apply with the forward contract hedge strategy to hedge the US payment. So यहाँ पे बोल रहा है अगर forward करते हैं forward contract करते हैं तो what is the payout? USD call option strategy. If you do the call option strategy, then what is the payout? If Globe Tech uses euros to settle the invoice. So if you see, they've given USD INR, but they've also given us Euro INR rates. So they're saying if we use the Euro INR rate, then what will happen to the payout? Okay. And then it says synthesize the results from all the hedging strategies above. If INR is expected to depreciate, so abhi INR kya tha? 83.2 per USD. It's saying if INR depreciates to 85.5 USD. So then recommend the best hedging strategy. So first it is asking us to compute by 3 different methods, and then it is saying if the INR depreciates to 85.5, then what is your recommendation from the above 3 methods? Yep. Again, if you understand the concept, it is simple to solve. All it needs is understanding of the concept and of course appropriate practice so that you can apply that concept which you've understood. So dekhte hain ji how to solve it. Okay. So first, the forward contract. If you want to make a payment of 500,000 USD in 3 months time, you will, applying the forward contract, you will lock in the rate of 84.1. That means after 3 months, going back to the concept of what we discussed, forwards kya hote? You lock in the rate today for something to be done in the future. So here, what you're saying I will lock in the rate today for USD to INR for something to be done in the future. Let's understand this a bit more because we are doing the forex calculations for the first time in this session. I'm not going into the detail, of course, considering the time, but very simple. What does that mean? Spot rate means if you go to the bank today and you say, bank, I need USD 500,000 or USD 5 lakhs. The bank will say, okay, I will give you 1 USD for 83 rupees 20 paise. That means you will pay to the bank, bank, here is 83 rupees 20 paise. Bank will say, thank you very much, here take your 1 USD. So अगर आपको spot rate पे लगान payment करनी है, that means today you will be making a payment of 500,000 into 83.2. But you don't need to make the payment today. You have to make the payment 3 months later. So therefore, what you are saying is, I don't want to take the risk of what will be the exchange rate in 3 months later. The exchange rate may increase. I may need to pay more. So I want to lock in the rate today and be, risk free. Whether rate increases or not, I don't care. And what is the rate? 84.1. That means if you go to the bank after 3 months into 84.10, this comes out to be 42050,000. So 4.2 crores 50,000. Yes. First, let's go to the second. Analyze the USD call option strategy and compute the maximum rupee outflow. इसमें क्या हो रहा है? इसमें bank is saying, you are saying, I don't want to go for the forward rate. I want to go for options. What advantage is option giving you? If the rate moves in your favor, that means right now the rate is 83, but let's say the rate moves to 80, then you don't need to exercise the option. You will say, I will go to the bank and just pay 80 rupees per dollar. So option is giving that flexibility, that optionality, but at a price. What is that price? Premium of INR 0.9. So in this case, you will pay the premium upfront. What are you paying for the premium? 0.9 into 500,000. That you will pay right now. Right? 450. Now, you will see if I exercise the option, how much do I need to pay? If you exercise the option, you have to pay 84 rupees per dollar more. So then you will pay 84 into 500,000, which is 4.2 crores plus the option premium which you've already paid. So the total outflow in this, under this option, is 42450000. So slightly higher than what you would have paid under the forward contract, but this is giving you the optionality. Yep, clear? आगे चलते हैं. This is interesting. If you have to use euros, that means you have to use a different currency, a third currency, to compute your forex exposure. Now इसमें क्या है? आपको रेट दिया हुआ है this and this. Now in 3 months later, how many euros would you need? Let's understand the question first. If Globetech uses euros to settle the invoice through the cross currency route, assess the euro amount required and the INR outflow using the 3-month forward rate. So what is the euro amount which is required? USD का कितना amount था? 500,000. What is the rate after 3 months? 1.12. That is when you have to make the payment. So what is the euro amount which is required in 3 months time? 500,000 divided by 1.12. Why are we dividing? Why we are not multiplying? Because of the way the rate is given. इसको लिखो आप. What is the rate? Euro INR, Euro USD is Euro INR. So let me show you the calculation. We need the rate of Euro USD. Yes? Do we agree? Do we agree? Rates which are given to us. USD INR and Euro INR. Is this Euro INR or just a second? This should be Euro USD. Just a second, I am checking one thing in the question. Yeah, this is not Euro INR, this is Euro USD. In the question, this is USD, not INR. Yep. So, I was saying, you've been given the rate of Euro USD as 1.12. So let's write what does this rate mean? What does this rate mean? Euro USD. It says 1.12. What does this mean? This means 1 euro is equal to 1.12 USD. This is the meaning of this exchange rate. And therefore, what you need to do, you need to compute the euros equivalent to 500,000. That's why you will divide 500,000 by 1.12. And this comes out to be 446428.57. 446428.57. Yes? So far, all good. So the question asked us to do two things. One, assess the euro amount that we did. The euro amount is 446428 euros. The second thing which the question is asking us to do is the equivalent INR amount. Now, if you see, we don't have an exchange rate for Euro INR. We have an exchange rate for USD INR. We have an exchange rate for Euro USD, but we don't have an exchange rate for Euro INR. So we have to compute. So the step one is compute the exchange rate. What do we need? We need how many INRs per euro? How will we do that? We will use the rates which are there. We have the rate of INR upon USD. If you multiply this by USD by euro, USD get cancelled. Do we get the rate INR by euro? That is exactly what we have to do here. What is the 3-month rate for INR USD? 84.1. So 84.1 into 1.12 by 1. This was given here. and we also used it here, 1.12. So this gives us the rate 84.1 into 1.12, 94.192. So this is the euro INR rate. Now we have the euro equivalent figure, we have the euro INR rate. So if we multiply these two, we get the amount, which is 4250. Just multiply 446428.57 into 94.192. Now if you see, if you understood the concept, the amount is same as forward contract 42050000, 42052000. Why? Because the exchange rates have been derived by using the same forward rates. So in the class we'll go into a lot more detail, but because this is just a revision lecture, giving you an overview of the forex rates. So this gives us the answer to the third question, or third part of the question, where it asked us to compute the euro equivalent amount and the INR amount. So the euro equivalent amount is this, and the INR equivalent amount is this. This is your answer to the third part. Now let's move on to the fourth part, where it says synthesize the results. That means compute the results as above from all the hedging strategies if the INR is expected to depreciate to 85.5. So INR was 83.2. Now in the fourth part, INR has increased to 85.5, and it is asking you to compute the answer for all the three things. So let's start with the base case. No hedge. Then you will pay 500,000 into 85.5. 500,000 into 85.5 gives you 4275000. Second, forward contract. Now, even if the exchange rate increases, you would still pay 84.1 because that is the rate which you locked in under the forward contract. That gives you the same answer as 42050. 4205000. Third, call option. Again, call option price is 84, market price is 85.5. So you will exercise the call option, and therefore your payout will be the same as above. What will be your payout? It was 424540, 424540. Yes, and lastly is the euro rate, euro cross rate. This will be 4205000, because it should be the same as the forward rate. Right? For completeness, for euro, you can have a different answer if you feel that the forward rate is not moving in the same direction. But I feel that will be confusing, so let's take the first answer as well from an examination standpoint. Yeah. So if you see, the best option is the forward rate, giving you the lowest along with the euro rate. However, if the company, or in this case the investor, wants optionality, then they can also go for the call option, which is slightly higher, but gives you the option of taking the advantage of an upside. Yep. So with that, we complete the question around Globetech, which was on Forex along with derivatives. I know there must be few concepts which were not discussed in the derivatives class because those are Forex concepts. So if you think those are not clear, you want to explain or have any questions, feel free to ask right now, or of course, you can always reach out separately and we'll be more than happy to answer all your questions. Let's move on to the last concept for today's session, which is interest rate swaps. And then we look at one examination question on interest rate swaps as well. So let's understand what interest rate swaps are in simple terms first. Let's read this question and then I will explain the concept first and then we'll also solve this question. This is again an examination question, 6A from December 2017 for 8 marks. There are two companies, M and N. M wants to borrow in Canadian dollars at fixed rate. N wants US dollars at floating rate. This is what they want. ठीक है, पहले सिर्फ क्वेश्चन पढ़ेंगे बेसिक सिंपल तरीके से. The interest rates which are available for M, if he wants floating rate, then it's US dollars LIBOR plus 0.5%. If it is fixed, then it is getting Canadian dollars at 6%. For N, it is LIBOR plus 1%, floating, and Canadian dollars 4.5%. Now, if you see what is happening in the question, M, as I said, wants to borrow fixed Canadian dollars. N wants floating US dollars. Fixed Canadian dollars, floating US dollars. Yes? But if M borrows fixed Canadian dollars, then he'll pay a higher rate of 6%, whereas N can get the same rate, same loan at a lower rate. Similarly, if N goes for floating, it will pay a higher rate, M can get the same at a lower rate. So, the concept of interest rate swap is, in very, very simple terms, two parties, they want loans. The loans which they are getting are at an unfavorable term as compared to how the other party can get the loan. I will explain that once again. Let's see, I want a loan at 10%. If I go to my bank and say, bank, I want a loan. Bank says, I can give you a loan at 15%. My friend, he has a better credit history. If he wants to take a loan from the bank can give the loan to that friend of mine at 8%. So instead of taking a loan from the bank, what I'll do is, I will first take a loan from the bank, but then I will exchange that loan from my friend. So my friend takes a loan, he gives it to me, I take a loan, I give it to him. And whatever is the savings, we share that between ourselves. This is a very crude, simple way of explaining it. Now let's go back to the question and solve it. And discuss it first, understand it, and then solve it. Right? So, M wants to borrow Canadian dollars, while N wants US dollars at floating rate. F, a financial institution, charges, if it arranges a swap, 50 basis points. 50 basis points spread. Iska matlab kya hua? It's their commission. It's their fees. So there is an intermediary who is charging a fees for arranging the spread between M and N, so between me and my friend. Design, if possible, a swap to share the benefits equally. That means whatever are the benefits between the swap arrangement, those will be shared equally between M and N. Discuss the steps of action in the swap and arrive at the final effective interest rate for M and N. Hopefully, the requirement of the question is clear. Arshad, you're saying FMBDA, CFS, but FFS is not understandable. So, Arshad, can you just elaborate on what FFS is here? What exactly do we mean by FFS? Are you talking about SFM? Message what exactly we mean by FFS, and then I can explain that. No worries. Right. So coming back to the swap, what are the steps? Let's understand. M, N, bank or intermediary. Yes? अब क्या हो रहा है? N wants so let's start with M. M wants a fixed Canadian dollar rate. N wants a floating rate. So M wants fixed CAD, floating USD. Right? So, how will this happen? N, right, can take what? N can take the fixed dollar rate at a lower interest. M can take the floating dollar rate, the USD dollar rate at a lower interest. So M, actual borrowing, floating US dollars, fixed Canadian dollars, right? So very simply, both take the loan in which they can get the lowest rate, even if they don't want that, that's fine. Both will borrow that. Okay? That's the first step. Second is, and LIBOR is London Interbank Overnight Rate. It's a reference rate which was highly used in the past for such intermediate transactions. So it was used as a reference rate. So like a common rate which was understood by everyone as a base. Now of course this has been discontinued, and you have SONIA, which is Sterling Overnight Interbank Rate, and some of the other rates which have come up, but LIBOR was extensively used in the past. Now, N has taken a loan at fixed rate and M has taken a loan at the floating rate. So M will pay what? M will pay a LIBOR plus 0.5%. N will pay 4.5 fixed. This is the interest rate which they will be paying, right? Simple. इसमें कोई confusion नहीं है, कोई doubt नहीं है, based on what we've done so far. Right? Now let's move on. I will also give you a shortcut to test your answer, but let's just understand what's happening first. Now, how will this work? M wants a fixed rate, but right now it is on floating. What is the floating component? The floating component is this reference rate. So M will give this floating component to the bank or the financial intermediary, and bank will give this floating component to N. So this floating component goes from here, and it comes here. Now this N has a floating rate, interest rate which it wanted. M has a fixed rate which it wanted, but of course the rate is not yet fixed. N will pay something to the bank, and bank will pay that something to M, taking 0.5% as its fees. The net result will be M has a fixed rate, bank has a 0.5% spread, and N has a floating rate. Conceptually, this is what will happen. Yes? Now let's look at the actual steps on how to achieve this. Okay? Conceptually, this is what will happen. I will tell you how to best do it in terms of the effective rate, and also then calculate or work out the steps. So, as I said, यहाँ पे हमने सिर्फ फैक्ट्स लिखे, प्रेफर्ड चाहिए, M को फिक्स्ड कैनेडियन डॉलर्स, N को चाहिए फ्लोटिंग USD, ऑप्शन जी है. Now, first step is compute the savings, the maximum possible savings on the swap. How will you do that? M can take a loan of fixed 6% and N can take a loan of fixed 4.5. How much is the saving here? 1.5% can be the savings. Correct? N can borrow at 4.5 instead of M borrowing at 6. So you save 1.5 there. Same for floating. What is the maximum savings? 0.5%. Because the parties each can take the loan at a lower rate. One party can take the fixed loan at a lower rate. The other party can take the floating rate at the lower rate. You can have both the savings. So you can have a total savings of 2%. That is the first step. Second step is you remove whatever is the intermediary fee. So in this question, the intermediary fee is 0.5%. So if you remove that, then what you are left is with the net benefit. Correct? Now, the net benefit is 1.5. Question says the net benefit will be shared equally. If the net benefit is shared equally, that means this 1.5 will be shared between M and N 0.75%, 0.75%. Yes? That makes sense? Now, if you've computed the benefit, then you already know what will be the effective rate for the two parties. How? Let's look at it. N will borrow at what? Will borrow at 4.5, but of course they will eventually get a LIBOR rate. LIBOR rate कितना मिलता उसको? L plus 1% पे मिलता. What is the benefit? 0.75%. So what should be the effective interest rate? It should be LIBOR plus 0.25%. Automatically, you've got the answer. Now you just need to work out the steps. Similarly, M के लिए क्या होगा? M को कितना मिलता फिक्स्ड रेट? 6%. Benefit of 0.75% shared. Effective rate for M is 5.25%. So first step, you compute the benefit. Second, you reduce any intermediary cost. You come to the net benefit. You bifurcate that net benefit based on what the question says. If the question is silent, then you assume the benefit is shared equally between the two parties. Once you know the benefit amount, then you can compute the effective interest rate. And once the effective interest rate is computed, then it is very easy to compute the steps. Let's look at the steps now. So as I said, loans actually borrowed. You will borrow whatever you can borrow at a lower rate. M could have borrowed LIBOR plus 0.5. N could have borrowed the fixed rate at a lower rate. So they borrowed that. How much is the interest which you will pay to the bank or the financial intermediary? You will pay the interest rate what you have borrowed on, but between the two parties, you will have some arrangements. What will be that? As I said, the first step is always that you swap LIBOR. That means the reference rate. So who's paying reference rate? M is paying reference rate, but M wants to pay fixed. So M will get LIBOR and N will be paying LIBOR. So as I said here, M will pay LIBOR to the bank. Bank passes it on to N. So LIBOR cancels out and reaches N. LIBOR reaches here. How much is the fixed rate to be swapped to reach to LIBOR plus 0.25? So N is paying LIBOR plus 4.5. L will only pay LIBOR plus 0.25. So 4.25 L will receive from M. So N receives 4.25 from M, and therefore the rate for N becomes LIBOR plus 0.25. However, there is also a spread of 0.5. So M will pay 4.25 to N and 0.5 to the financial intermediary, and therefore it comes out to be 4.25 plus 0.5 plus 0.5, 5.25%. And this is the effective rate which we had computed before the workings. Does that give you the answer? And this is how you will solve for an interest rate question. I will repeat the steps for the benefit of everyone. The first step is you see which party can borrow which loan at the cheapest. If both the parties can borrow one type of loan at the cheapest rate, then both the benefits can be combined, as was the case in this question. So we started by seeing how are the benefits being combined. 1.5 and 0.5. So 2% can be the gross benefits. Second step, you see if there is an intermediary and what is the fees which is to be paid to the intermediary. So the fees to be paid to the intermediary was 0.5. Therefore, you came to a net benefit of 1.5%. Once you've computed the net benefit, then you see how's the benefit being shared. In this example, in the question said equally. If the question is silent, please assume equally and include a note. So if 0.75 are to be shared by both the parties, then you can compute the effective interest rate. How will you compute the effective interest rate? You will see N wants to borrow at floating rate. If it borrows the floating rate, then it will play LIBOR plus 1%. Subtract the net benefit, 0.75. So you come to L plus 0.25%. Similarly, M wanted to borrow at a fixed rate. If it would have borrowed at fixed rate, it would have paid 6%. You take the 6% rate and you subtract the net benefit. That gives you the effective rate of 5.25%. Once you compute the 5.25% effective rate, then you do a reverse calculation. As I said, you start by first transferring LIBOR. Once you transfer the LIBOR, then all you have to do is do a simple maths calculation to say, I want to be at LIBOR plus 0.25. Whatever I at, that amount is 4.25%, which is received by N from M. And there is a 0.5% of fees which is to be paid, which gives you the effective interest rate of 5.25 and LIBOR plus 0.25, which is the same as your effective interest rates computed here and here. So those are the steps involved when it comes to interest rate swap. With that, we come to an end of the session today. Thank you so much. Hope this was useful. Again, I will repeat, please practice all of these questions along with the others, of course. once you've gone through the concepts again. In case of any doubts, we are more than happy to help you. Please feel free to reach out. And also, repeating the point that you may see differences between the answers where we've done the questions in the session vis-a-vis what's there in the suggested answers or in the scanner. So there will be some mistakes in the scanners, and therefore there is some difference in the answers. Thank you so much. And as I said, please feel free to reach out in case of any questions. Thanks.